leading into the deferred sales trust, which is the last and final part, the core of what we do, the core of what we're experts at, deferred sales trust, which is a tax strategy by which the seller of any highly appreciated asset may sell that asset, defer the taxes owed for the year of sale, and they have flexible investment options. So you see all this content on our website. You can hear us talk about this on a webinar every month. If you've spoken with us, you'll see us chanting this slogan every day. But it really is that clear. It really is that simple. A few in terms of, when people talk about limitations, in our opinion, and call us biased, but due to the unique advantage that we can serve any seller of any asset, we believe our strength is in our structure's flexibility with few restrictions, limitations. So in terms of any asset can be sold, and investment classes, as long as it's a viable investment, a seller can invest there. So that's a lot more flexibility and control. And of course, Greg dived deeper, but that's high level what we do.
All right, thank you, Paul. So last on our list today is the Deferred Sales Trust. And again, this is the core of what's available to a given, seller of an appreciated asset that's looking to mitigate the tax associated with selling that appreciated asset, right? 1031 exchanges are also among the list. It's just, I think that's fairly commonly known, and we've done other webinars about 1031 exchanges and the pros and cons and the risk factors associated with 1031. So I just want to mention that it really is on the list, but we're just not covering it today because we have done that before. But just so you know, we can answer questions about 1031 exchanges that you may have as well. So that being said, there's not a lot out there, and deferred sales trusts is one of these strategies that I tell a lot of people, it's not new, but it's new to a lot of people. It actually has a deeper track record than opportunity zones, for example, and similar track record in terms of time as a Delaware statutory trust. Been around like 27 years now, but because the deferred sales trust is highly specialized and niche, there are not dozens or hundreds or thousands of other tax attorneys or other firms trying to replicate the deferred sales trust strategy. The main reason around that is because, it takes years and years to get the IRS to sort of, turn their head and pay attention, and then want to dive in and do deep level scrutiny. They'll do some audits, pick around the edges, and then at some point years down the road, they'll go directly to the creators, the sponsors, or whoever is put together, in our case, our tax team, and do deep dives and, go through years of transaction records. So they want you to build up a pretty deep case file because they want to review all of it and see if they have any problem with it. So that's what it would take for anybody to try to replicate this. And nobody to date really has done that, or if they've tried to do a startup, they don't have the track record behind them with the IRS audits, reviews, et cetera. So anyway, just a quick background on the DST, and for our purposes today, I want to be pretty objective, and I think hopefully I have been with regard to these strategies, because they all have a place. They all have a place. For years, I have personally helped clients in each of these areas: Delaware's, charitable trust planning, and opportunity zones. And then for the last 6 years as a trustee for the Deferred Sales Trust, one of only 16 nationwide, I've been able to add that into the repertoire and actually really specialize in this area because, again, I'm trying to be objective, but I must say that, the Deferred Sales Trust is the greatest thing to happen since the invention of sliced bread. I mean, if I would have had this in my quiver of options when I'm trying to assist clients over the years, my 30 year experience, I would have been thrilled to have that in the mix. I did a lot of 1031 exchanges as a real estate professional for clients, things of that nature. I helped them exchange sometimes into Delaware statutory trust because they just couldn't find ideal replacement property, things of that nature. So, but the Deferred Sales Trust, its core benefits are that it's legal, proven, and IRS tested, number one. Number two, it allows sellers of any kind of appreciated assets, business, real estate, personal residence or investment property, land, any kind, cryptocurrency, collectibles like fine art, things of that nature. Pretty much anything that can appreciate in value that you want to sell, that would be subject to a tax consequence. The DST is an appropriate vehicle for all of it. Some of these others, as we've gone down the list, they're very narrow. Delaware's only real estate. Charitable remainder trust, you can sell various things, but you got limitations on what you can do after you sell it. Opportunity zones, you've got some core things that you can sell and put the money into opportunity zones. Primarily, it's real estate, businesses, and stocks. But the deferred sales trust could be anything. We've had people selling jets that have gone up in value per private jets. We've had them sell businesses. We've had them sell cryptocurrency, a whole myriad of businesses, whole myriad of stuff. And so it allows those sellers to defer the capital gains taxes, control the reinvestment of the funds without restriction or limitation. So some of these strategies have some limitations. Charitable trusts have some limitations. By definition, Delaware's and opportunity zones are going to be focused in, hard assets, real estate mostly. Okay. Deferred sales trust, you can be in equities, you can go back into real estate investments as an active or a passive investor. You could invest in, do hard money lending. There's really no restriction or limitation on what that can happen. And then you also can control your income and your tax benefits. So in every other strategy, there's going to be a sponsor, and it's going to be a long-term hold, and they're going to make all the decisions, how much they're going to pay you, when they're going to sell, all of those factors, right? With the deferred sales trust, you actually have that control. So you're going to direct or approve how the trust invests the money. You're going to direct how much you want to be drawing on it on a periodic basis. You're going to determine if you want to cash out early, and you can at any time, or you're going to determine how long you want it to run. And there's no limitation or time limit where you have to cash out and pay your taxes. So it is a tax deferral strategy, as I said. So you're basically electing, instead of taking all the money in the year of sale, you are electing to receive your proceeds plus an attractive rate of return over some period of time that you shall determine and negotiate with your trustee. And in doing so, you get to keep the tax money you otherwise would have paid in the year of sale, working directly for your benefit to generate more income for yourself, faster wealth accumulation, or maybe a combination of both. And you get to kind of set the parameters. And over time, if you need or want to change how much you're drawing, or some people just call it my income from my DST, that's flexible as well. So lump sums are available, changes in the income stream up or down, or even deferring it, to be resumed at a later date. That's a lot of the flexibility that is inherent in the deferred sales trust strategy. And obviously, those who attended other webinars of ours, we've done some deep dives on various levels of the deferred sales trust. So I didn't really intend today to get too deep into the mix, but I did want to mention and just piggyback on something Paul said earlier, which was a great point, is that sometimes clients are interested or more favorably inclined to go the deferred sales trust route, but there may be a situation in their particular transaction where we have to combine the deferred sales trust with, for example, a Delaware statutory trust in order to fully defer all of the capital gains. And that particular scenario is really a mortgage over basis on real estate that you're selling. Probably occurred because you did a cash out refi along the way, and then later on you're selling it, and now your mortgage is higher than what your original cost basis is, right? And then after depreciation write-offs. And so sometimes we can combine more than one structure to meet your goals and your needs. The deferred sales trust also has the potential, with a kind of a companion strategy, we have the DST, the DST Plus, but if you've got a really large estate, or you're selling a very, large asset, could be 10 million or more, 20, 30 million, folks in that zip code, they've got an estate tax problem. So our planning can also include estate planning that moves a lot of these assets outside of your taxable estate for estate tax reasons, but still gives you the benefit of all the income for the rest of your life and the ability to pass it on to your designated children or heirs. at your choice. So that's a whole different webinar to talk about that in detail, which we will get to. But having said that, Paul, you wanna flip it to the other side, and maybe we can see if anybody's got any questions. So this is just a little compare and contrast matrix, if you will. So we want to list all of the strategies we've talked about today across the top, and then some of the benefits down the left. So, tax deferral. Do these strategies provide tax deferral? Yes, they do. Charitable remainder trust actually provides tax avoidance initially, and things are taxable as they move forward. But yeah, tax deferral is available on every one of these strategies. Are each of these strategies IRS scrutinized and approved? Yes, they are, every single one of them. What about flexible investment options? The only strategy that has flexible investment options is the Deferred Sales Trust. Now, granted, if you wanted to go into a Delaware or an opportunity zone, for example, typically you're going to be in real estate. You can pick the fund in the area and the location and the project you want to invest into. But after that, it's not like you're going to diversify into other asset classes, which, hopefully you have other investments that do that if you go that direction. Now, the Charitable Remainder Trust does have flexible investment options. So I think, we need to turn that red X into a green thing. But there are some limitations on the flexible investment options with the CRT. So I'm just noticing that now. So something that we'll modify, but know that that's the case. What about, can client modify distributions? Well, you cannot in the Delaware, the CRT, or the Opportunity Zone, because that's completely at the control of the sponsor, the group or the syndicated you've invested your money with. They will control all of those factors. They will try to give you an idea of what they expect. Things could change, but they'll give you an idea of what to expect, but they will control all of those factors. With the Deferred Sales Trust, you can modify, working with your trustee to modify the level of distributions you choose to receive, because there's no minimum or maximum. It could be, I want interest only related payments. I want a specific amount of money. I want, I want to be earning 6, 7, 8% in total, but I only want to draw the equivalent of 3 or 4%, whatever, so that I can experience income and growth at the same time in kind of a balanced approach. So that can work there. Is there indefinite tax deferral? No. I mean, on the Delaware, no. Ultimately, when they sell the project, you're going to get paid out. That's just how that works. Charitable Remainder Trust, you get tax avoidance at the sale of the asset. And after that, aside from the tax benefits we talked about, there's no more tax deferral amount because you avoided the taxes initially, but you'll pay taxes on, generally speaking, on all the earnings and all the income and stuff that you receive. At the end of the day, the charities get the money. They're a tax exempt organization, so they won't pay tax ultimately on the inheritance, even if there's capital gains built up inside of that. Opportunity zones, same kind of thing as the Delaware. When they finish the project and they can start selling it out, then you'll get paid out at that point in time. The DST, on the other hand, is completely up to you. You kind of control the length of time you want to keep this open, and it could theoretically pass through generations of your family as a legacy play if you wanted it to. So you have control. In the other strategies, somebody else has control. And then the final rule comparison is, can each of these strategies be used with any type of asset sale? And the answer is no. I mean, Delaware statutory trusts, if you're trying to defer taxes, it means you're selling real estate and then using it as a 1031 play to go into that. Charitable remainder trusts, most assets you can utilize for a charitable remainder trust, provided that you create the trust first, you transfer ownership of the asset to the trust, then you put the sign in the ground, as we say, and sell it, and then operate forward as discussed. So CRTs do have flexibility for a lot of asset classes to be used, because the whole idea of the code is to give people incentive to donate to charities so that the government isn't responsible for taking care of everything in this world. We get some charitable organizations that probably do a better job, quite honestly, than the government in serving local and community needs that are not otherwise provided for elsewhere, right? Opportunity zones, again, you can defer. You can use an opportunity zone to defer various types of asset classes, again, primarily real estate, businesses, and stocks, but not necessarily everything under the sun. So you do have flexibility there, but not, if we use the term any, any means all. Deferred sales trust, pretty much anything that you have appreciated in value can be sold. Now, there may be some limitations and some criteria on some of these things. We talked about it in credited investor status for a Delaware and for an opportunity zone, right? No real specific limitation on charitable remainder trust as far as the value or the amount of gains that you're trying to defer. There's no real minimums there. You just kind of have to look at the underlying, fundamentals and financials of what you want this to do for you and whether it's worth going through that process and kind of tying your hands a little bit if it makes it worthwhile. So it's really a personal choice there. With the deferred sales trust, really that's going to be appropriate if what you're selling, or if you have more than one asset that you're going to be selling over a relatively short period of time, that the combined tax hit would otherwise be $100,000 or more combined, then the deferred sales trust can be an effective and appropriate vehicle. But if what you're selling, and it's the only thing you're selling, and the tax result is going to be, let's say, $50,000, at most, federal, state, and Obamacare tax, then the deferred sales trust might not be appropriate for you for that particular transaction. But maybe one of these others could be, right? So this is where you can kind of pivot and why it's important, I think, to compare and contrast. So, Paul, do we have any questions?
Yeah, we got a few great questions, Greg. I think you'll like this one. So we'll start with Roma. She said, opportunity zones include life insurance with cash benefits too?
Life insurance with cash benefits. Roma, I'm not sure I understand the question. Typically, life insurance is not an asset that you'll necessarily sell, as the springboard into a tax deferral strategy, because as we know, cash value life insurance by design, that is a tax deferred entity, right? And then life insurance can't be the recipient of the sale of something that would be subject to taxation. In other words, I can't sell my building and roll it into a life insurance policy. That's what's called, we have 1031 exchanges for, exchange of like kind real estate. We have a code section called 1035, which is the exchange of life insurance from one policy to the next. So if you have built up gains, tax deferred gains in a life insurance policy, and you want to exchange it into a different life insurance policy and roll it all over into a different carrier or a different contract, that's what's known as a 1035, like kind of exchange, insurance to insurance. So, if Roma, if you want to clarify that, if I didn't answer your question, please do. What else we got, Paul?
We got Stephen. Great question, actually. Regarding opportunity zones, do the capital gain elimination after holding for 10 years only apply to the capital hard assets, or does it encompass goodwill as well?
It would encompass goodwill as well, because goodwill is a term that's used in the sale process of your business, right? You're allocating how much to goodwill, which is usually the lion's share, how much is fixed assets like plant and equipment or trucks or machinery, stuff like that. That really is more how the allocation within your sale structure works. But, since goodwill is deferrable, and it is subject to the capital gains, so your entire capital gains, including goodwill, is deferrable into the opportunity zone. And if you, although you will have to pay taxes, though, don't forget, by 2026, you're still going to have to pay taxes on the total capital gains, including goodwill, by the end of 2026. But then on the new investment that you go into, you hold it 10 years or more, then whatever that asset grows to will be free from capital gains taxes, 100% excluded. Hopefully that helps.
Yeah. Robert, where is it regulated that a sophisticated, not accredited investor can invest in a Delaware statutory trust?
Those are like SEC regulations. I think it's probably codified into the IRS code as well. But SEC and FINRA regulations require certain types of investments only be offered to accredited investors, and it's sort of that minimum threshold. You have to have at least $1 million in assets aside from your home, or you can have to demonstrate that that on your tax returns that you make at least $250,000 to $350,000 a year for the last couple of years. And the primary reason for that is whenever investment requires accredited investors, those assets are not going to be short-term, nor are they going to be liquid. They're going to have to be maintained inside of that investment for some period of time, 3 years, 4 years, 5 years, 10 years. And so they don't want sponsors taking money from people that can't afford not to have that money back in a short period of time. Just don't have the resources in case of emergency, because if they're desperate, you're not going to be able to get your money out of this thing. Unlike owning a mutual fund or something like that, you can liquidate that tomorrow.
Yeah, liquidity is huge. I think follow up to Robert, he asked, can't an owner of a Delaware statutory trust beneficial interest exchange for another DST, Delaware Statutory Trust, beneficial interest directly? If a DST, Delaware Statutory Trust, beneficial interest is placed into our structure, Deferred Sales Trust, can it be traded for another beneficial interest at the owner's discretion?
Let's see if I understand that question. So you can sell active real estate and exchange into a Delaware. You can exchange from a Delaware into another Delaware. You can use the Deferred Sales Trust at either of those junctures too. So you could, sell your active real estate and go right into a Deferred Sales Trust. You could have a Delaware ownership where you probably exchanged from something previously, so you still have all your built up capital gains inside of that. You could use the Deferred Sales Trust to get out of the Delaware when it's going to be sold and closed out, or you could have the option to do another 1031 exchange into another Delaware. So that's flexible.
So Roma, appreciate that for everyone who is here. We will be sending out a recording as well. So I know we've gone through a lot of information. Any follow-up questions, feel free to reach out to us, 714-881-1362. Greg's email is greg@reefpointusa.com. My email is paul@reefpointusa.com. We are available to answer any follow-up questions. If not, we'll be sending out the email with the follow-up link when it goes live. And again, any questions anyone has, a comparison saying, hey, my client is very comfortable with Delawares, which we currently have a real estate owner located here in Southern California. He has about 25 properties. He's been very comfortable with 1031s and Delawares in the past. So for him, this was something new he wanted to explore. And I think the difference in showing the flexibility, the investments, distributions, the estate planning part of it, how it can go to your children and they can continue the deferral if they wanted to. I think folks find a lot of value in that. So a lot of information. Great job, Greg. And thanks for joining, guys. Any questions, feel free to reach out to us.
Yeah, thank you, everybody. I realize, the time that we spent here is quite a bit. So I really, appreciate, you taking the time to, learn with us and participate. So much appreciated. We'll try to make sure that some of our future webinars are a little bit shorter and more digestible, but there was a lot to cover today. So I really appreciate your attention and your interest. So thanks, everybody. Have a great holidays. We'll talk to you next time around.
We'll see you in a month.